A C corporation is its own taxpayer. It computes taxable income, then pays federal tax at a flat 21%. That sounds simple, but the big exam theme is double taxation. The corporation pays tax on earnings, and then shareholders may pay tax again when those earnings come out as dividends. Also remember, dividends are not deductible by the corporation. On the EA exam, they love AMT is gone, except it isn't. The old corporate AMT was repealed, but the Inflation Reduction Act created the Corporate Alternative Minimum Tax, or CAMT. At a high level, it's a 15% minimum tax based on adjusted financial statement income, and it generally targets very large corporations averaging over $1 billion of financial statement income. A key C Corp concept: income does not keep its character when it reaches shareholders. The corporation might earn rental income, interest, even tax-exempt bond interest. The corporation handles the character at the corporate level. When it distributes after-tax earnings, shareholders generally just see a dividend. Contrast that with S Corp and partnerships, where items pass through with character. Here's the weird but testable part. If a C corporation distributes property, it can trigger corporate-level gain. In a non-liquidating distribution, appreciated property is treated like it was sold for fair market value, so the corporation recognizes gain. But if the property is worth less than basis, the corporation generally cannot recognize a loss on that distribution. Gain yes, loss no. Now zoom out to why C Corps sometimes hoard cash to avoid shareholder dividend tax. Congress responded with the accumulated earnings tax. It's not automatic. It usually shows up after an audit when the IRS argues the corporation accumulated earnings beyond reasonable business needs to avoid shareholder-level tax. So this is a motive test plus a reasonableness test. Memorize the exam numbers. The accumulated earnings tax is 20% on excess accumulated earnings. A general safe accumulation is $250,000 or less for most corporations, and $150,000 or less for personal service corporations. But the best defense is documentation. Specific, definite, and feasible plans, like expansion, buying another business, or known liability needs. When they ask what counts as reasonable needs, think concrete plans, not vague intentions. Expansion to a new facility, acquiring another business, budgeting for product liability exposure, or even setting aside funds to redeem stock in a deceased shareholder's estate can qualify if the amounts are tied to realistic estimates. On the exam, specific and feasible is the phrase to look for. Harborview Financial Group is a cash-basis C corporation. It distributes property to a shareholder in a non-liquidating distribution. The property has a fair market value of $120,000 and an adjusted basis of $72,000. How much gain or loss does Harborview recognize on the distribution? Think about it. The answer is $48,000 of gain. In a non-liquidating distribution, a C corporation generally recognizes gain on appreciated property as if it sold the property for fair market value. So it's $120,000 minus $72,000. The tempting wrong answer is 0, because people confuse this with non-recognition rules for certain contributions, not distributions. When you start with taxable income, which transaction decreases a C corporation's earnings and profits? Choices include a dividends received deduction, completed contract long-term contracts, mine exploration costs deducted currently, or corporate dividends and other distributions to shareholders. Think about it. The answer is corporate dividends and other distributions to shareholders. When taxable income is your starting point, distributions reduce earnings and profits because E&P is tracking the corporation's ability to pay dividends. A tempting wrong answer is the dividends received deduction, but that's a taxable income adjustment. Distributions are what directly reduce E&P.